It's under your name. You look at the logo. I changed it. Everything is under your name. When I got the bill, I know you. You're still bringing it under my name. Yeah. So it's like, and I'm
thinking I put it on PDF. No, I hadn't.
But
Yeah, no,
it's not.
also,
No,
yes, it might have.
no, we're doing
I'm just fucking around.
That's just like bullshit that I'm doing. And there's a term because when I called them, they were saying like, oh, if you don't have like an electric leak or something, like call us back. So I just have to like figure out a way. I think I'm gonna email them.
Okay, folks.
I got it.
I'm going to hope that by this session, my nagging has worked and you've all picked a company. So I will work with that assumption from this day on. But here's where I want to see tangible proof you picked a company. Remember that master spreadsheet I've been harassing you about? Go in and enter the name of your company in that spreadsheet. Now, as I said, you always reserve the right to change your mind. But I'd like to see the companies, and don't worry about what other people are picking. So if somebody else has picked the company you're valuing, not a big deal, right? So 5 people valuing Google, right? You get 5 different values. A couple of things before we start, before I forget. As you know, Monday is a holiday. It's President's Day. I don't know what you plan to do for President's Day. I'm never sure what to do with it. But Wednesday, class will be entirely online on Zoom, not at the classroom. So don't show up here. There'll be nobody here. You can always show up here and watch a Zoom session here. If you're that attached to this room, I wouldn't be. So relax, stay at home. You can watch a Zoom session on Wednesday. Okay, so I want everybody to remember that. And the link is on Brightspace, but I'll also make sure I send it to you again so you know the link for the Wednesday class. So today we're going to leave equity risk premiums behind. We've talked about risk-free rates. We're going to finish off equity risk premiums with a few closing ends. And then I'm going to do something that's going to look like it's destructive. I'm going to dig a big hole and I'm going to bury the way you've been taught to estimate regression betas in whichever classes you've taken in finance. I'm going to talk about all the things that are wrong when you run one regression. Again, if you've been in my corporate finance class, you know how much I dislike regression betas, but there's no harm repeating why I dislike them so much one more time. So today's start of the class test is starting that process of why you shouldn't trust regression betas. So here's my first test. Petrobras, I've run 2 different regressions. First regression, I've taken Petrobras's local listing, it's Sao Paulo listing, and run it against the Bovespa. Second regression, I've taken the ADR, which is the listing that Petrobras is in the US, dollar denominated, same company, and run it against the S&P 500. So I've got all the output from the regressions. If you have to run a regression beta, so let's say you've decided you're going to use a regression beta. Against my advice, which of these 2 regression betas would you use, and tell me why? Yes.
The one in on the left side.
And tell me why.
Because the R square is higher.
Okay, I knew exactly that was coming. Statistics class, what are you told? R squares are higher, that's a better regression, right? But let's dig a little deeper. Why is the R squared higher when I run Petrobras against the Bovespa than against the S&P 500? It's nothing to do with statistics. Tell me what it is about Petrobras and the Bovespa that makes the R squared higher.
And it's a large share of the Bovespa.
It is a large share of the Bovespa. I take Siemens and run it against the DAX. My R squared is, so if I follow that reasoning, I should run regressions against nice, narrow local indices. My R squareds will always be high, right? This is not a statistics test. If you pick regressions based on R squared, you're going to be ending up with regressions that look good statistically, but are terrible estimates of betas. We'll talk about why. Now, does that mean I'm going to go with the S&P 500? The R squared is lower. The regression is against a broader index, but there are a whole host of issues that come with picking that as well, right? In fact, if I ask you to frame this regression perfectly, there is no way you can frame it perfectly because every choice you make will come with consequences. And I'm going to say up front, all these regressions are crappy. Any individual regression beta to begin with is so flawed. You have to wonder, do I want to build a valuation? Of course, that leaves me open to what are you going to do instead? Because in many classes, that's the only way you're taught to estimate beta is run a regression. I will follow. If you were in my corporate finance class, I argue if you don't trust a regression beta, there's a better way to think about betas, which is from the bottom up. You tell me what businesses you're in. Beta measures macroeconomic risk. It's got very little to do with the individual company. I can build up to a beta for your company by looking at other companies in the same business. So let's take that forward. There are two ways I can define other companies. I can define them as companies that look just like mine and end up with a small sample, right? I can put in multiple layers, same industry group, same country, same revenue size. And remember with Capital IQ, which I'm sure all of you have, I know you have it, but you got to do it soon. My nagging has so many multiple dimensions now, I forget what I've nagged you about. But if you get on Capital IQ, you can pretty much look for companies based on whatever criteria you said, and you can come up with companies that look very much like Petrobras and end up with a small sample. Or you can be a little looser on our criteria and end up with a larger sample. So based, without looking at where we're going to end up, if you have to pick between a small sample of companies that look like your company to get a beta for your company, or a large sample of companies that might have differences, which is a better choice? You say small sample? Okay, I have a small sample. Does anybody want to disagree? What? You want a large sample. So we're tell me your rationale for a small sample.
Looks like more or less the same. It has more, the risk profile is actually the same.
But if I go down that road, there is a sample size of 1 that's perfectly like my company, right? Which is just my company, right? So why did I leave it? Because when you run a single regression, things can happen. There's noise, there's one slice of history. So when you say, I want companies like mine, you're going to end up with a small sample, and that small sample, it might be better than having 1 company, but 4 companies is still a small sample. You can have strange things happen. The reason we do this is statistical. It's a law of large numbers. And what does the law of large numbers require? Humor me? Large numbers, right? Which means I'd rather have a sample of lots of companies that are not like mine. We're going to face this because many of you, when you value emerging market companies, let's say you value, you're looking at an Indian automobile company. Part of you say, I want to look at other Indian automobile companies. There's an advantage to that, right? They share a common geographical base. But now how many are you going to get in your sample? 4 companies, maybe. I'm saying, given a choice between 4 Indian companies and looking across 400 global automobile companies, I know there are lots of differences, but remember, this is just on risk. I'm not doing PE ratios or pricing these companies. There you might make a different judgment, but when it comes to risk, big samples will beat out small samples. Now we'll talk about when you might not want to go global. You might say, look, there's a reason for me to stay with just Asian companies. We'll talk about why you might constrain it, but your first instinct should be, let me get a large sample, and then I'll start to prune to make it maybe a little smaller, but still acceptable. So as you look at the criteria, you're going to say, and I think we've, for the last, as long as markets have been around, when you think about similar company, what are you trained to think of? If I give you a steel company, let's say you work at an investment bank, and your managing director says, go find the peer group. What are you trained to do? Go find other steel companies. Software, go find it. We're sector focused. And I'm going to argue that that's probably not a great way to think about comparable firms. I'll give you my definition of a comparable firm when it comes to risk. A comparable firm for me is one that goes up when I go up, does well when I do well, and does badly when I do badly. Nowhere in there is there a sector component. And I'm going to argue that for some companies, the best group you can look at to judge risk has nothing to do with the sector. I'll give you a preview. Let's assume you're looking at consulting firm that's Houston-based. You're a consulting firm that's Houston-based. You know what the disproportionate number of your clients are in, right? What business are they in? They're in the oil and gas business. I would argue a better beta for you as a consulting firm is not the beta of other consulting firms, but the beta of the oil and gas business. You know, if you do this at an investment bank, your managing director says, what the heck are you doing? And I think you need to be able to explain what we're trying to do on a risk measure. We're trying to think about things that are driven by the same macroeconomic risk forces. And that might have nothing to do with sector. So file that away, because as I said, today we're going to spend a lot of time kind of dismantling the traditional way of thinking about betas. But let's move back to where we were in the valuation packet. And I think we were on page 81, right? I left you with this page where I said, look, you know, my justification for using implied equity risk premiums is not because I think it's smarter and more intelligent or even forward-looking. It just works better. It works better at predicting what the returns in the market will be in the future. And that's the ultimate test of, is this a good measure of equity risk premiums? And I also said the worst way to estimate equity risk premiums is look backwards, historical premiums. And unfortunately, 95% of valuations are built on historical premiums. Now, there are a few other things about implied equity risk premiums that make them appealing. Remember the way I came up with equity risk premiums for countries? Very convoluted, right? I started with the US premium, then I did this dance about, hey, it's not default risk, but that's the only thing we have. And I used ratings and default spreads, and I scaled up and I came up with equity. A lot of layers there that you can question each layer. Wouldn't it be neat if we didn't have to make any of those assumptions? If I could give you the implied equity risk premium for India or Brazil or China without doing this rating dance and multiplying the default spreads, how did I compute the implied equity risk premium for the S&P 500? I took the level of the index today. I didn't need any historical data. I project our expected cash flows in the index and I solve for an internal rate of return. Right? It's a generic process I can apply to pretty much any index. In fact, in September of 2007, I decided to try this for the Sensex, the Indian Equity Index. Getting the level of the index is easy. You should be able to get that for any index. I have the level of the index. We need cash flows. And in fact, it gets simpler when you leave the US because often the only cash flow you get from stocks is dividends. There are no buybacks. At least in 2007, there weren't. Now things are changing. In 2007, the only cash flows you'd have got would have been dividends. And that dividend yield in 2007 was 3.05%. So I've got my index level. I know what the cash flows were last year. And then I'll give you the next input because this is the one I struggled on the most. With the S&P 500, remember I projected out growth over the next 5 years using what analysts were forecasting? And the S&P 500, because it is the most widely followed index in the world, has analysts who give me those numbers, so I don't have to do the work. That was tougher to do with the Sensex. There are no analysts who track the Sensex. There are people who track individual companies, but within India, they don't project 5-year growth rates, they project 1-year growth rates. So I cheated. About half of the companies in the Sensex have ADRs listed in the US or GDRs listed in the UK. And in those companies, I was able to get 5-year growth rates. It's the weakest link here, but I took that growth rate and used that as my growth rate and cash flows for the next 5 years. You see what I'm building up to, right? I've got the dividends, I'm growing them at 14%. And after year 5, I set the growth rate equal to the risk-free rate. Exactly the same rule I used for the US, but the risk-free rate was much higher. I have the index, I have the expected cash flows forever. So basically, when I solve for the required return, I'm getting what Indian investors are pricing in as a premium when they buy Indian stocks. and they were pricing Indian stocks to 11.18%. You subtract out the risk-free rate, you come up with an equity risk premium of 4.42%. Question?
Why would you do that instead of just taking the default risk? Because that's more accurate.
Well, because this is what people actually pay. The default spread approach is built on a series of presumptions, right? What's the biggest one?
I'm assuming that the ratings are correct.
No, we're assuming you're a global investor and you have choices, right? Because think about that picture, right? If you don't, let's say the premium in India becomes lower than what your default spread should suggest. In a world where capital can flow, here's what would happen. Money would leave the US, to India, and go to another country with a higher risk premium. But if I trap you, as Indian investors are often trapped, investing predominantly Indian stocks, you could argue that the risk premium you actually see in markets like India and China can be disconnected from the default spread approach, because you're forcing investors to buy those stocks no matter what. And that actually is a good opening for why this approach is so useful. Let's assume that I'm a global investor and I can compute these implied premiums for all 160 countries. It's going to be quite a challenge because of growth, but let's say I could do that. You see how this can now become the basis for global allocation of my portfolio? If India is earning only 4.42% as a premium, and I can make 8% as a premium in Indonesia, I can check the ratings. Is it because of difference? And you can say, you know what, I can get a better bang for my buck investing in Indonesia. It's a much better way of doing it than doing what portfolio managers do today. Look at PE ratios across countries, kind of invest in low PE. This is an approach that brings in the level of risk-free rates, a growth rate, and the risk, and and it's completely model agnostic, right? I'm not using the CAPM or an arbitrage pricing model. I'm just backing out from the cash flows what your required return is. So if you're worried about bubbles in emerging markets where investors are trapped in that bubble, one way it's going to show up is the equity risk premium market will keep drifting down well below what you can earn in a mature market. Right now, the Indian equity market is priced to earn an equity risk premium, a little lower than the US market. Take from it whatever you might, right? Indian investors might have no choice. They're saying, what choice do I have but to buy Zomato at 81 rupees per share or pay 35 times earnings? And you're right, you have no choice, but I do. As a foreign institutional investor or a global investor, I can decide where to allocate my money. So think of the default spread approach as what the risk premium should be. Think of this approach as what risk premiums actually are. Remember what I said, you got to live in the world you're in, not the world you wished you were in. You don't get to set prices. You got to take the price and say, am I okay with that price? This gives you that price.
But over here also you're projecting cash flow,
Yeah.
right? It is again an assumption.
Oh yeah, you're making, I mean, but the assumptions are, no, it's the assumptions are what's driving the market. That assumption is not a model assumption, right? It's not what should be. It's basically you're trying to make your best estimate. You could be wrong, but remember, if you're unbiased, you can be too high or too low. That by itself can't explain why premiums are low consistently. So in 1 year, I might overshoot or undershoot, but you have to make estimates no matter what. Yes.
So for all emerging markets, there will be some disconnect between the growth.
Not necessarily. A lot of emerging markets are not closed markets. If you're an emerging market like Turkey, where investors can, Turkish investors can invest outside Turkey. Don't assume that every market is like India and China are truly closed markets. Investors, domestic investors are actually restricted from investing outside. Malaysian investors are not restricted from investing outside. They can invest anywhere they want. So not all emerging markets have this constraint problem, right? So you can't assume a disconnect in every emerging market. Brazil doesn't have that disconnect. Brazilian investors can invest outside Brazil. Chilean investors can invest outside Chile. The problem in India and China is because of restrictions on investing outside the market, you can get disconnects.
So a follow-up question:
Yeah.
if we take that growth rate for ADRs,
Yeah.
which might not be representative of the whole.
Now we're at, that's an estimation question, right? So you can ask, how much higher would the growth rate have to be? I don't think I'm underestimating growth rate, to be quite honest. If anything, by focusing on companies that have GDRs and ADRs, I might be overestimating growth rate. There's no ex ante reason that I can give you that growth rate number is going to be too high or too low. But that's an estimation challenge. And that's why I don't do this yet for 160 countries. There will be a day though where I will do this. And you know what? I'll happily abandon that default spread country risk premium dance. Or maybe I'll do it on the side just to get a sense of where countries are relative to where they should be. But you can't do this with a historical premium. Or if you did, it'll be meaningless. An implied premium. So think of this as a more sophisticated version of looking at PE ratios, which portfolio managers do all the time, right? Because it is affected by what you're paying relative to earnings, but it goes beyond that. It brings in growth, it brings in cash flows. So it's a more complete measure of markets. You know what? Both the Indian and the Chinese government know they have a problem. The problem is they know that they're creating these distortions in the market. But you know why there's no easy solution? Because the minute you open the market up, what's going to happen?
Outflows.
Outflows, because people are going to say, I don't have to settle for a 4.4% premium. This is a risky market. The Chinese government has actually wrestled with this over the last decade because they've tried to give little escape hatches for Chinese domestic investors to invest outside. But they've often had to close the gates very quickly because when they open the gates, it looks like money rushes out. And so that creates, so there's but the problem is the longer you put this off, the worse the problem is going to be. I mean, I don't advise governments, but if I were advising the Indian government, my advice is take your punishment now, take the medicine and kind of adjust, because it's healthier for everybody involved to have that choice. It's healthier for investors, right? Because you're no longer trapped. You're not creating these mini bubbles in India now, because if Indians believe equities are overpriced in India, you know what they have to do, right? They have to take the money out of equities. And where are you going to go? Indian real estate? Well, that's overpriced too. And if that doesn't work, you're going to see Bitcoin and gold. And I mean, this has been the story of Indian investing for a century. And it's not healthy. It's not healthy for companies either, because when your implied premium is too low, what are we doing to Indian companies? We're lowering the cost of equity to levels that are really not globally competitive. So they can basically raise this subsidized capital. They can take projects that look good because they beat the subsidized equity risk premium, but they're really taking projects they shouldn't be taking as global competitors. Yes?
I'm sorry, one more. Risk-free rate over here that you calculated, is it the one?
I clean up the default spread. So it's always going to be, so once we did that, from that point on, all risk-free rates, I'm going to be using my version of risk-free rates. It's never the government bond. One final, or two final examples of implied premiums. Now, the country where I've gone pretty much every year for a long time, where I've done this every year, is Brazil. So this graph actually, the red portion of the column is the US equity risk premium, the implied premium. The total column is my Brazilian implied equity risk premium. And the difference is what the market is building in as a country risk premium for Brazil. So the difference here is they're building up to premium default spread and saying, I'm going to take the implied premium for the US, implied premium for Brazil. That difference is what the market is charging. So in 2000, if you look at it, the US premium, that's the bottom of the peak of the dot-com boom, close to 2%. The Brazilian premium almost 3 times higher. That is, the worries about Lula getting elected. And for a while, you can see the spread is huge. And then you start to see it start to drift down. In fact, just before the 2008 crisis, the Brazilian country risk premium had become small. Again, I'm not making any model judgments or theory judgments. This is what Brazilian stocks were being priced on. Then you got that jump back up again during the 2008 crisis. And then it started drifting down again. And in fact, by September of 2012, the premium had gone to almost zero. Brazilian equities were being priced to earn roughly the same as US equities. And you know what the story then was, right? We're in a new world order where there is no developed market. It's like the 2008 crisis. We're all developed markets or we're all emerging markets. Now, the only thing was under the surface, there was still a lot more risks in Brazil than there were in the US. And you can run from reality only so far. And post 2012, you saw that adjustment back again. In fact, the spread got really large in September of 2016. And for those of you familiar with Brazilian politics, this was the car wash scandal, president getting impeached, et cetera, et cetera. And it stayed pretty high. It's kind of come down over the last few years, but it's not where it was in 2000. You see the advantage of tracking these numbers over time. You can see when markets get disconnected, because they sometimes do, even if they're global flows, because people get over optimistic or they get over pessimistic. So this is an advantage you can get when you start to do implied premiums on a regular basis, because you can be wrong, but at least you're getting a sense of trend lines, right? You're making so you can get a sense of consistency in how you do things. One final table, and then we leave implied premiums alone. As you know, on my website, I maintain these data sets that are computed by looking at every publicly traded company at the start of every year. It sounds like a big deal, but remember that's why I want you to get on S&P Capital IQ. It's a data, raw data. I get the raw data, download the spreadsheet. And every year, after I've done all my data sets, I do a very simple exercise. I take the 46,000 companies and break them down into developed market and emerging market companies. And there's an element of subjective judgment here. Should I put Greece in the emerging market or the developed market column? And I make my best judgment. So there's some noise, but now I would have these two groups. Then I take the price to book ratios collectively for each group. So I'm getting a sense of what the market is paying. And I do something very much like an implied equity risk premium for the two groups using very broad assumptions. So here's what the implied cost of equity look like for developed market companies. And these are all in dollar terms, so I can compare them. In 2004, the cost of equity, the implied cost of equity for developed market companies was 7.28%. The implied cost of equity for emerging market companies was 10.55%. That difference was what the markets were charging because emerging markets were riskier. Keep your eyes on that last column. And as you go through time, you'll notice it drifts down. It's a little bounce back up in 2008. You saw that in the Brazil numbers as well. But at the end of 2012, that number was down to 0.29%. Again, let me tell you what I see here. Collectively, investors were pricing emerging market equities to earn roughly the same returns as developed market equities. And lots of stories again, end of 2012, this is how things are going to be. But again, you're ignoring the fundamentals, which said that emerging market companies still are riskier fundamentally than developed market companies. So that's an advantage of the implied premium. Go ahead.
Why do you use the price book?
You can use any pricing multiple. You can use price earnings. You can use, but the way they set up because basically the way I solve for the cost of equities, you give me the equation, whether it's PE or price to book. I have this intrinsic value equation. So later on in this class, I'm going to show you what that equation is going to look like. It's for PE, it's driven by payout cost. So with each multiple, I can come up, it's the same underlying valuation equation. It's a stable growth dividend discount model. And I'm solving for the R in the model based on the pricing. So I could have used revenue multiple. I could use earnings multiples, any multiple that I wanted, as long as I can come up with the cost of equity. Yes.
So which one of these measures you think is the better one, price to book or the one?
It doesn't matter. As I said, if you do it's the same equation. Underlying it is the stable growth dividend discount model. Price is equal to expected dividend divided by cost of it. I can take that model and write it as PE ratio, price to book. You'll get exactly the same answer no matter which multiple you focus on, because the way you set up the equation will be different, but it's the same underlying dividend discount model in every single equation. So now let's talk about betas. We've all taken finance classes, and I remember my finance class. I was told the way you estimate a beta is you run a regression. A regression of returns on the stock against returns on a market index. The slope of the line is a beta. What a horrifically bad way to think about betas. First, there's no economic intuition left, right? It's a statistical regression. It's a slope of a line. And in fact, I'm going to make the case that a regression beta is fundamentally flawed for three reasons. First, statistical. Remember when you ran regressions in statistics and you reported your regression output? You show the coefficient, which is what the beta is, but right next to it, you showed a standard error and a t-statistic, right? Why do we do that in statistics? To be truthful, which is you made an estimate, but it's an estimate. It's not a fact. This is how wrong I can be. So I'm going to show you how wrong a regression beta can be, even if you set everything up right. Second, a beta is backward looking. Stating the obvious, why is it backward looking? To run the regression, what do I need? Returns. To get returns, I have to go backwards. I can't go forward. I can't tell you what the returns will be. So by definition, a regression beta is backward looking. So it reflects your company as it used to be over the 5 years. Even if the regression beta is perfect, it reflects what your company is saying. What's the big deal? How much can companies say? Imagine taking a 5-year regression for Disney. You know what you'd be missing for the last year and a half or two? What's Disney become? It's become a streaming company with all this side business, right? Everything is driven by what's happening to Disney Plus. The business mix has changed. And it's not just the business mix. The beta you get from a regression is an equity beta. At the risk of throwing in a buzzword, it's a levered beta. It's a beta that reflects the business you're in and how much debt you chose to run the business. And if your company's debt ratio has changed over the last 2 years and 5 years, what company's debt ratio hasn't? It can go up, it can go down. Your regression beta, even if it's perfect, is going to reflect the wrong debt ratio. So I'm going to use 4 regression beta pages to make my case. This is the regression beta page for GoPro. You know GoPro, you familiar with GoPro? Camera for oversharing, overactive people. You put the GoPro on your head and you go on a 3-hour walk and you think I'm going to be interested. You record the whole thing and you put it on YouTube. And only one person has watched the video and say, what the heck happened? The one person is you watching yourself walk for 3 hours. But for a while, it was a high-flying company doing really well. I valued GoPro, I don't know what, 6 years ago. I didn't even remember when. It's on my blog somewhere. And I had to come up with a beta for GoPro. So I decided to try the conventional route. This is the GoPro beta page. This is a beta page from Bloomberg. That's the other thing I want you to find is either get Bloomberg Anywhere working on your computer, which you can, or if you can get a Bloomberg terminal, get to it. Because if you find your company, and you should be able to find your company who's publicly traded, type in the word beta, a page like this will pop up. And magically, if you look at the top of the page, it says raw beta. That is your regression beta. If you follow your textbooks, that's the beta you should be using for GoPro. But before you get too excited, keep going down. This item standard error of beta. You know what that tells you, right? Statistically, it tells you how wrong you can be on your beta. Take a look at that number. It's 0.50. So let me try this out. Your regression beta is 1.60. Your standard error is 0.50. If this were a statistics class and I asked you what's your beta, your answer shouldn't be 1.60. It should be a range. Remember what that range is? If I ask you for 95% confidence, it's plus or minus 2 standard errors, which means your true beta can be 0.6 or 2.6. Forget about 99% because you might as well say it's all noise. But even with 67% confidence, which means you're going to be wrong a third of the time, your true beta for GoPro can be anywhere from 1.1 to 2.1. That's extreme because it's a very young company. But you know what the median standard error for a beta estimate in the US, it's about 0.2 to 0.25. That's the range you get, even for mature companies. So first problem with betas is they're noisy. Second problem is if your beta looks really good, like it did for Petrobras, and this is an even better looking beta. This is a regression beta for Nokia in 2000. This looks perfect, right? R squared is close to 100%, standard error is close to 0. If I followed the R squared rule, I should be jumping for joy. But this is a completely useless regression. You know why? Take a look at the index. The hex. That's a Helsinki exchange. You're saying, what's Bloomberg going to Helsinki for? Bloomberg is very parochial. You ask for a company. It looks at where the company is incorporated, runs a regression against that index and reports a beta. Nokia is a Finnish company. You know what percentage of the hex Nokia was in 2000? It was 80%, 80% of the hex. No wonder the regression looks so good. What have you basically have a regression of Nokia against Nokia, right? And they move together an awful lot of the time. But here's why it's useless. Betas measure the risk added to your marginal investor's portfolio. Say, who's the marginal investor in Nokia? The largest investor in Nokia in 2000 was Barclays, and they held Nokia as part of their global index fund. If you're Barclays, you're not measuring the risk of Nokia by seeing how it moves with the hex. You'd probably run it against the MSCI, some global index, and guess what's going to happen? You're going to get a more meaningful beta, but what's going to happen to your standard error? It should go up. This is a feature, not a bug. If you run a regression beta and you show the standard error at 0.05 and expect me to congratulate you, you're not going to get the congratulations since they've done something wrong. This is not the way company-specific risk works in a diversified portfolio. So don't trust regression betas when they look bad. Don't trust them when they look good. Doesn't leave you a whole lot of room for when you should trust them. But I'm not quite done with dumping on regression betas. With the regression beta, you're one slice of history. You want to remember one slice of history? You've taken the last 5 years. Just to show you what can happen. Last year, I took GameStop. This is right in, when it was in this frenzy. And if I asked you just before I ran the beta, do you think GameStop is a risky stock, whether you like the company or not, given that the stock had started 20, gone up to 400, moved back to 150? It's, of course, it's risky. And then I ran a regression beta. Guess what my regression beta is? Minus 0.62. You would be insane to value GameStop with that as your beta. Let me ask you a question. Why, when companies or stocks go haywire, does the beta do strange things? What does beta measure? It measures how your stock moves with the market. Repeat that to yourself. It's not a measure of volatility, it's a measure of how your stock moves with the market. And when GameStop was going through its frenzy, the market didn't matter, right? On any given day, whether it went up or not, did not matter. The market was not even a player in the game. Same thing happened to Merck when it was part of the Vioxx lawsuits. Every time a lawsuit got settled or Merck was found guilty, the stock price would kind of move. For, I think, almost 3 years, Merck's stock price was the mercy of those Vioxx lawsuits. Its beta went close to zero during that period. So whenever something big happens to a company, good or bad, over a period, and contaminates 3, 4, 6 months of data, your beta will not reflect the true risk because of something that happened during that period. And finally, remember we talked about bias? How when you sit down to value a company, you've already made up your mind whether you want to see a high number or a low number. Let's say you decide you want to get a high value for your company. And don't ask me why. It might be your incentive system. And you sit in front of a Bloomberg terminal and you notice that you have choices. What I mean by that is on a Bloomberg beta page, you can change the index. You can change the starting and the ending point. You can change the intervals from daily to weekly to quarterly. You can even change from trade prices to bid-ask prices, the middle. You think, so what? I've told people, you give me 30 minutes alone with a Bloomberg terminal and tell me what beta you want for your stock. I'll deliver a printed page with that beta. You want a beta 1.5? Not a problem. You want 0.5? Not a problem. You play enough games with indices and starting and ending points, you can get whatever. You see why this is deadly when you're an analyst? You don't even realize you're cooking the books when you do this, because you keep telling yourself, it's a Bloomberg terminal, this is a beta page. I'm just changing a few things. But you're doing it in a way that leads you to your preset conclusion, which is you want this company to be undervalued, overvalued. If I had my druthers, I'd remove every Bloomberg terminal from every analyst desk. It creates more damage than good. Nothing good comes from playing with the beta page until you get to a beta you want. So I don't like regression betas, but but there are people who don't like betas at all. Now, every 2 or 3 years, the last decade, I've had the misfortune of ending up in Omaha at a certain time of the year. You know what happens in Omaha every year? It's what I call investing Woodstock, where these 60 to 70-year-old value investors come in from all parts of the world to Omaha, and they worship at the feet of the master. Now, 2 90-year-olds get up on the desk. One is, is very irascible, Charlie Munger, basically. I think he's lost all censoring mechanisms as he's gotten older. So it's actually fun to listen to because he says whatever's on his mind. And Warren Buffett. So I never go to the meetings myself because that's not that's not what appeals to me. But I get, these portfolio managers who come in actually try, pick outside speakers to come and talk to them. For whatever reason, I end up getting picked every time they run these polls. I keep trying to tell them things that are so mean that they won't invite me back again, but they keep inviting me back. So I remember the first time I landed, this is a value investing crowd, right? I asked the question, how many of you actually value companies? You project out the cash flows. Not a single person in the audience actually valued companies. You say, how can they be valued? They pick screens, low P ratio, low price to book. They ran the Ben Graham screens. If you take a look at the Ben Graham screens, there's no DCF in there. It's a bunch of screens. So I said, but you claim to be value investors. You care about value. Why do you not value companies? You know what the most common answer they gave us? Because we don't like betas. And remember, they're drawing from, again, the deity they've come to worship here. Warren Buffett has said he doesn't like betas. And they said, well, we don't like betas, and therefore we can't do discounted cash flow valuation. To which my response is, we're throwing the baby out with the bathwater here. You don't like betas, then come up with a different way of adjusting for risk. In fact, while I was in that audience, I completely abandoned my presentation because this was too fascinating a question. I said, why do you not like betas? And there are two broad critiques people of betas, and I think both are reasonable. The first is that beta is price-based. You know what I mean by price-based? You run a regression of returns. And what do we do in intrinsic value? We say markets are usually wrong. So their first thing is, why would I want to trust a price-based measure of risk when I'm an intrinsic value investor? I said, good point. The other critique, the reason they don't want to use betas, is that betas are based on the presumption that investors are diversified. And one of the tenets of value investing is you concentrate your portfolios. We don't want to get this measure of risk you cannot. We want a risk that captures the total risk in the company. So we care about things like management quality, whereas you might not from a diversified investor standpoint. I said, okay, let's come up then with a way of measuring risk that reflects why you don't like betas. In fact, if you don't like the assumption that investors are diversified, that's your main reason, but you don't mind the price-based measures, I'll give you alternatives to traditional betas. The first is in traditional betas, we actually look at the portion of the variance that you cannot diversify. That's a covariance in the numerator. We're assuming the rest can be diversified. It's a very simple fix if you don't like that. Instead of using the covariance, which is the portion of the variance that comes from the market, what if I looked at the total standard deviation in your stock? By itself, that's just a number, right? So let's say the standard deviation of IBM is 30%. And let's say the average standard deviation across all US stocks is 25%. You know what I'm going to do? I'm going to take the 30 divided by 25. It's called a relative standard deviation. I'm going to come up with 1.2. Looks a lot like a beta, but now I've abandoned the diversified investor assumption. You don't like that? Let me give you a second way you could do this. Instead of even trying to measure beta, what if you use something as a proxy for risk? People have done this as long a time. Tech companies are risky, utilities are safe. Maybe you can come up with a way of estimating and be pure judgment calls as to what your cost of equity has to be by business. In fact, there are some brokerage houses that break companies down into numerical classes of risk. Value Line, which is not a brokerage house, for the longest time, for almost 50 years, has broken stocks down into 1 through 5 in terms of safest to riskiest. You can have different costs of equity. I'm okay with that. You're bringing in risk. You might not use a model, but you've come 90% of the way towards what I want, which is a risk-adjusted discount rate. But the way in which people who don't like the diversified investor assumption deal with that assumption most frequently is to start with the CAPM or some risk and return model from finance. The CAPM, risk-free rate plus beta times equity risk premium. And then they start adding additional premium, small cap premium, companies, which is basically, I don't like this number. It looks too low to me. So I'm going to get to 18%. They call it a build-up approach to cost of equity. I call it make-it-up approach to cost of equity, because basically you have an end destination. You're going to get there by hook or by crook. But you know what? I'm okay with it. That's the way you want to come up with cost of equity. Might not be what I do. That's one way to go. If you don't like price-based measures, though, which is what the three that I described gave you, then things get a little messier, because if you're not going to trust prices, you're going to tell me what else you're going to focus on: earnings, debt ratios. And I'll tell you, with all of these alternatives, here's a fundamental problem you're going to have. How often can prices be measured? Every second of every day, they move. Daily, hourly, minute. How often are earnings recomputed? For US companies, 4 times a year. For many European companies, twice a year. In some parts of the world, once a year. You see where I'm going? Remember the law of large numbers? So basically so if you're okay with that, then it's okay. I can come up with a measure of risk that's not based on prices. A lot of intrinsic value people believe in earnings, right? So to them, a risky company is one where the earnings are volatile, and a safe company is one where the earnings are stable. When I compute risk measures for companies at the start of every year, I actually take the last 10 years of operating income for every company. And then I compute the standard deviation across the 10 years. Let's say the standard deviation in operating income for your company is 18%. And the average standard deviation of operating income across all companies in the market is 20%. You know what I'm going to do next? I'm going to divide the 18 by the 20. I'm going to come up with 0.9. Looks again, see, the end game for me is I need a measure of relative risk. Traditional beta measures get me there, but so does the relative standard deviation, and so does computing these accounting risk measures. If your focus is debt ratios, that's what freaks you out, then I'm going to take debt ratios and use that as a basis for coming up with relative risk measures. There are, in fact, people who actually come up with cost of equity by looking at your cost of debt, which is observable. You know what I mean by that? You're a company, you borrow money from the bank at 5%. I say, you know what? Equity is riskier than debt. Then I make up a multiple. Equity is twice as risky as debt. 2 times 5% is 10%. You know what? I'll take that too. It's not the way I would do things, but my point is, you don't like betas, or you run into somebody who has this deep aversion to betas. Don't fight on that hill. It's not worth fighting on. Accept it. Say, okay, rather than use betas, tell me what your measure of risk is. I'll try to come up with a cost of equity that reflects it. Now, I fought that fight, and then basically I concede. If somebody has a big deal on it, say, okay, you come up with a different way of measuring risk, I'll bring it in. Because to me, this is a small piece of a much bigger puzzle. Those Fangam stocks I valued last week, the valuations I get almost, you could use whatever proxy for risk you want. My valuations are probably going to be within 5 or 10% of what I got. So now let me get back to betas. Because often we ask people where the betas come from, they say from a service. Let's face it, that's the way most people getting betas get. They get from Barra, from Bloomberg. You dig a little deeper, they come from regression. But that's not true either, because ultimately the beta you see for a company is a function of 3 choices the company makes. And those choices are not in some market. They're operating choices or financial choices. Let me explain. When you as a company enter a business, whether you like it or not, that choice of business is already setting you on a pathway to a high beta or a low beta. Here's why. Betas measure how you move with the market. If you enter a business which is cyclical, you'll have a higher beta than if you enter a business that's non-cyclical. Cyclical companies tend to move more with the market and the economy. But I have another distinction that I find useful. If your company produces a product or service that is discretionary, you know what I mean by discretionary? Your customers can live without it. They can delay buying it. They can defer buying it. You will have a higher beta than if you produce a product or service that's a necessity. There's a reason grocery retailers have lower betas than discount retailers, and discount retailers have lower betas than department stores, and department stores have lower betas than luxury retailers. Yeah.
So how would you classify Amazon? Is it a necessary or it's a luxury?
Well, what product or service does Amazon produce?
If you want to order, you'll order through.
Well, I mean, at one level, you can say it's a retail store that provides everything from toilet paper to luxury. So it's like a department store with none of the cost structure of a department store, right? It's like a Walmart which never runs out of inventory. So I think from that perspective, it's, whether it's a low beta or an average beta, but Amazon is no longer just a retail business.
Yeah.
So I think that each business has different risk characteristics, but Amazon's definitely not a risky company. The question is, how safe is it? No.
I was just interested in classification. So how
Yeah.
would you, if it has multiple businesses?
Well, it's closer to a discount retailer than it is to a department store, because basically you can get everything you want and you can get it at the lowest price. You can match Walmart prices on Amazon because they offer a multitude of merchants. So you tell me what you do. I've already started thinking about your beta. So you tell me I produce. Now I remember when Peloton went public. Yeah. And when Peloton went public, it was primarily an equipment company that sold this incredibly expensive subscription, right? I don't know how many of you have Pelotons. You had to sell it to come back to business school, right? But you can buy it back after you graduate. But it's what, a $2,500 to $2,500 bike and then $40 a month. Where would you put that? Is that a necessity or a luxury, you think? Well, if you have a lot of money, it's a necessity. But now, if you lose your job, you're not saying this today, you're going to give up on the Peloton subscription. I remember when it went public, I was on CNBC with this analyst who was very bullish on Peloton. And he said, everybody in my building has a Peloton. I said, maybe you should leave your building and walk a few blocks the other direction. You're looking at a very small subset of people. Does it surprise me that Peloton is swinging around like crazy? Not at all. When you sell a luxury product, in good times, you're going to sell a lot. In bad times, things are going to drop off because people can't afford it. So that's the first step. Tell me what you do. So you picked a company, right? You all put up your hands. I want you to think about what your company provides as a product or service. If it's in multiple businesses, what it does in each one. And then ask yourself, are customers for that product or service? Do they view it as a discretionary product or how discretionary? It's already going to give you a pathway of thinking about, should my company be a high beta company, an average beta company, or a low beta company? Second step, tell me something about your cost structure. The greater the proportion of your costs that are fixed costs, the higher your beta will be as a company. You see why? You have a lot of fixed costs. In good times, you make lots of money. In bad times, you lose lots of money. Companies with high fixed cost structures will have higher betas. This came into play when COVID kicked in and the whole global economy shut down, right? We take the hospitality business. The status quo, the traditional way in which that business was delivered was the hotel business, right? Now we can debate whether it's good business, bad business, but the hotel business is a huge fixed cost business. At least the way traditional hotel businesses are. Hilton, lots of fixed costs, whether you like their business or not. So when the economy shut down, guess what? They still had to maintain those buildings. They still had the fixed costs, which means their earnings just collapsed as their revenues went down. The newcomer in this business, the big player, of course, is Airbnb. Think of their cost structure. How much do they spend on the apartments they own? It's a trick question. They don't own any apartments, so there's no fixed cost. If nobody's renting an apartment, it's not like they're paying people, keep the apartment open. There are pluses and minuses with being an intermediary business, but one of the pluses is an intermediary business has lower fixed costs, which means they can scale down much more quickly and scale up much more quickly. Which means that Airbnb and Marriott might both be hospitality companies, but based on cost structure, I'd expect Airbnb to have a lower beta than Marriott. Actually, let me take Marriott out. You know what makes Marriott different from Hilton? What did Marriott do about 25 or 30 years ago that made their cost structure kind of different from other hotel companies? What's the biggest fixed cost that hotels have? It's owning the hotels, right? You know what Marriott did in the early 90s? That they took their real estate and they spun it off as a REIT. There's a Marriott REIT that owns all of the hotels, the Marriott hotels. Marriott the company itself just collects management fees. Very different business model. So you could argue that Marriott has always been safer than Hilton, and now Airbnb might be safer than Marriott. So the second thing I want you to think about is, what kind of cost structure does my company have? And the best way to see it, look at 2020. It's going to give you more proof about cost structure than any kind of detailed analysis you can do, right? Take a look at their revenues, first quarter, second quarter, third quarter, fourth quarter of 2020. Take a look at their expenses. If they're a truly flexible company, here's what you should see. You should see revenues drop off in the second quarter. I don't think there's a single US company other than maybe Zoom or one of these companies that was right in the heart making it, but the revenues didn't drop in the second quarter. But if you're a flexible company, the cost should also drop, maybe not as much. Airbnb lost money in the second quarter, but not as much as the companies with huge fixed costs. Which leaves me with the third choice you make that affects your beta. Tell me how much you borrow. Because when you borrow money, you create a fixed cost you did not have until you borrowed the money, debt, and the interest expense that come from it. And with that, I can actually be specific. You tell me what the beta is coming from your business and fixed cost structure. That's called the unlevered beta. I'm going to look at how much debt you have with the debt to equity ratio, and I'm going to scale up your beta for the fact that you've chosen to borrow money to fund this business. That's it. Those are the three things that drive betas. What business are you in? What fixed cost structure? How much debt do you have? So I'm going to use that opening to come up with a better way of estimating betas because I don't like regressions. I'm going to approach estimating the beta for a company in 3 steps. I'm going to start with the beta of the business you're in. Let's say it's a single business company. You can extrapolate to multiple businesses. I'm going to start with the beta of the business. If I can, you're going to see why I said if I can, I'm going to adjust for your cost structure. So if you're Southwest Airlines, I might start with a pure beta for being in the airline business, which already is this very risky business. But then the fact is Southwest, through its history, has been able to keep its fixed cost structure lower than the other airlines. And one way they did it was flying from one no-name airport to another one, so they didn't have to pay for the gates. So if I can somehow adjust for cost structure, I'm going to bring it. When I stop at step 2, I have an unlevered beta for your company that reflects the business you're in and your unique cost structure. Third step, I'm going to bring in how much debt you have to come up with a levered beta. In a perfect world, here's how I do it. But see the second step? It's really messy. I'll make a confession. I can't even remember the last time I even tried to adjust for fixed costs for a company. I think now I can give you exceptions like Southwest, and I'll tell you why it's so difficult to adjust for fixed cost structures. To adjust for fixed cost structures, I need to know how much of your costs are fixed and how much are variable. But I also need to know that for every company in your group. In other words, if you're 50 steel companies, you can tell me fixed and variable costs for each one. Adjusting for fixed costs is trivial. It's actually very easy to do. It's very much like the levered beta equation with fixed costs replacing debt and variable costs replacing equity. But unfortunately, that's not the way accounting statements are set up, right? I mean, you can try to guess that this is probably fixed, this is variable. But the reason we don't adjust for operating leverage is because we don't, it's not because we don't know how, it's easy to do. It's because the information is not there on fixed and variable costs. So somebody gives you a hard time about the fact that you're not adjusting for operating leverage. You know how you can make the criticism stop right away? Ask them to come up with the fixed and variable costs. Give them the list of 25 companies. You know what? Collect the fixed and variable costs for each of these companies and I'll adjust. Very quickly, the critique will end. Because they'll discover that the information is just not there. Now, in terms of leverage, though, there's an adjustment for betas that's almost 50 years. In fact, it's more than 50 years old. It's called a Hamada beta. You'll see this in every textbook, including mine, where you take the unlevered beta, which is the beta of the business you're in, you scale it up for the fact that as you borrow money, your debt to equity ratio goes up. You're saying, what's that 1 minus T doing in there? Remember, when you borrow money, the government acts as a co-guarantor and gives you some cushion by giving you tax savings. So it brings in the tax savings. Say a lot of fixed costs, oh, but by the way, you do get a benefit. It's called the Hamada beta. There are versions, variants on this. There are people who don't have the 1 minus T in there. So some of you might have worked at places where they're just the one. If you do that, though, be consistent. When you do your cost of capital, I don't want you to see a 1 minus T show up in your cost of debt there because that's inconsistent. But this approach, the Hamada beta and the variant, are based upon an assumption about debt that makes some people uncomfortable. When you use this equation for levered beta, you're assuming the beta of debt is 0. You're not assuming debt is riskless, but you're assuming if there's any risk in debt, it has nothing to do with the market. Is that a bad assumption? No, it's okay. If you have a triple B, single A, double A, triple A rated company, what's happening in your debt has very little to do with your equity. But if you're a low, if you're a high yield company, double B, single B, triple C, guess what starts to happen to the debt? It starts to act like equity. In other words, there is a beta for debt, and we're assuming with this equation that the beta of debt is 0. Again, if somebody gives you a really hard time, tell them, okay, I'm willing to adjust the beta of equity for debt. I know this is the equation if you have a beta of debt. The only problem is now I need a beta for debt. And that's not easy to get. Actually, in my book, I have betas for debt by ratings class. So if you really, really want to adjust for this, you can take the beta for debt for if you're a double B rated, it's like 0.4. If you're triple C rated, like 0.7, it starts to behave more like equity. You can bring it in. Again, it's not because we don't know how to adjust for the beta of debt. We use the approximation where the beta of debt is 0 because it makes our life simpler, but it could get us into trouble with very highly levered companies. So now let me lay out my end run around regression betas. You want me to estimate the beta for your company. I call this a bottom-up beta, but you can call it whatever you want. Basically, instead of using a single regression, a top-down, I'm going to build up to a beta from the bottom up, where you start with the business or businesses or companies. And remember, companies can be in multiple businesses. And you talked about Amazon. There was a time when Amazon was a retail company, but now it's in retail, it's in logistics, it's in entertainment, it's on the cloud. So you tell me what business you're in. Here's what I'm going to do. So let's say you're in 2 businesses, steel and software. Strange combination, but your company. I go find 100 publicly traded steel companies and 100 publicly traded software companies. They're publicly traded, so what can I get in each one? I can get a regression beta in each one. I take the average, no game playing, simple average regression beta across steel companies is simple average regression across software companies. That average beta is a beta that reflects the risk of the business they're in and how much debt they've chosen to take on, right? Software companies might have very little debt, steel companies might have a lot of debt. I take out the effect of the debt. It's called unlevering a beta, but essentially I want to see what the beta for these companies would be if I were looking pure. I get the unlevered beta for steel and software. And then I come back to you and say, you told me we're in 2 businesses, steel and software. How much value do you get from each one? And your response might be, I don't know how much value I get, but I get 80% of my revenues from steel and 20% from software. I take a weighted average. The problem with taking weighted average based on revenues is I'm missing a key ingredient of what drives the value of a business. Software business, steel business, which will tend to have the higher margins. Software tends to have 35 to 40% margin, steel has 6% margin. So I'm going to give you a little trick you can use, but rather than use revenue weights, you can actually come up with estimates of value that reflect what you truly make on these 2 businesses. But the end game is I end up with the weights for these 2 businesses. I take a weighted average of my unlevered betas. I now have an unlevered beta for your company. What's the last step? I'm going to ask you whether you have any debt. And you say, no, I'm done, because that's your levered beta. But if you have debt, I compute your debt to equity ratio, and I come up with a levered beta. Why am I doing all of this? Because I don't like regression betas, right? But where did I get the 100 software company betas and the 100 steel company betas? I got them from regressions. All I've done is replace one regression beta with an average of 100. You say, what's the benefit then? It's a law of large numbers. Remember I showed you the GoPro beta of 0.5? Horrifically bad beta, right? Let's say I have 100 companies, all of which look like GoPro. I get a beta and a standard, they all have 0.5. You know what the standard error of the average beta across 100 companies like GoPro would be? They each have a 0.5 standard error. What's the standard error across the 100 companies going to be? I picked 100 deliberately. It's going to be 0.5 divided by the square root of your sample size. 100. So in this case, 0.5 divided by the square root of 100 means my average beta is 0.05. This is like magic. I take 100 crappy numbers, I average them out, and the average is magically precise. You know why? Because you overshoot, you undershoot, the averages take care of it. That is the biggest salesman. So even if you're a single business company, why would you ever want to put all of your valuation on one slice of history, one regression, when you can let the law of large numbers work for you. And if you're a multi-business company, the bonuses start to proliferate. Because remember the steel and software company? Let's say you entered the software company business yesterday. There is zero chance your regression can reflect it, but I can bring it in because I set the weights. If you plan to be in the online advertising business next week, I can bring that into, I now control the process of what your beta is based on your business plans and your story. To show you, because every time you do evaluation, you come to this choice, right? Should I use that Bloomberg beta? Should I get a bottom-up beta? It's been almost 30 years since I valued a company with a regression beta. I don't even remember why I used regression beta. I think it was Eurotunnel, and I finally gave up. There were no other tunnels under the ground that were sucking up cash. And I said, you know what? I give up. But every time I come to this choice, I say, you know what? I'm going to take the bottom-up beta approach because I can't visualize myself trusting this one slice of history, single regression. So let me show you what this would look like for a multi-business company. It's a company that you saw in corporate finance, Vale, remember? Brazilian mining company. 5 different businesses. If you weren't in corporate finance, don't worry, it's a 5-business company. Or 4-business company, metals and mining, iron ore, fertilizers, logistics. You're saying, where do you get the breakdown of businesses? Most companies give you segment breakdowns. Some of them you might have to kind of finesse to see what you want to put them in. But ultimately, you got to put them in 4. So if you're thinking about Amazon, there is retail, there's entertainment, there is AWS. And the logistics business is really not a revenue generator. So basically 3 businesses. I get the unlevered betas for each of these businesses. This sounds like a lot of work, right? And actually, it's not. And here's why. At the start of every year, I do this for 96 different businesses. If you go to my website, you'll see the averages globally for the US. So basically, I go do both regional and global average, and I'll talk about why I provide both. So when I want to value a steel company, the last thing I'm doing is sitting in front of Bloomberg. So let me see what the starting and the ending point is, what index. I just go to the beta for global steel companies. And I use that unlevered beta. It's actually a lot less work, and it takes that out of my hand saying this is not. In fact, my Excel spreadsheet says a lookup. Where you pick the sector, it looks up the unlevered beta at the start of 2022. That becomes the unlevered beta for the business. And you can see the sample sizes, especially if you go global, are huge. Fertilizers, there are 693 publicly traded companies. I can be incredibly sloppy about each of the regression betas and still be okay because my sample size is going to bear it. This is why I don't get caught up in did I use 2 years or 5 years, because once you get to really big sample sizes, all of those choices fade into the background because the sample size takes care of it. But here's where it gets interesting. Vale did break revenues down by segment. And I could have used the revenue weights, right? But remember what we said, different businesses have different margins. So here's the trick that I used. Remember these companies from which I'm getting betas, they're all publicly traded. They have enterprise values, market's estimate of what they're worth. I computed what multiple of revenues companies in each sector trade. You're saying, how is that going to bring in difference in margins? You know what a typical software company trades at? 6 times revenues, 7 times revenues, because margins are so high. You know what a typical steel company trades at? Like 1.3 times. That EV to sales ratio is basically a multiple of revenues that reflects the quality, the profitability of these businesses. So you multiply the revenues Vale gives you by that EV to sales, you get an estimated value for each business. A little better than revenue weights because they reflect both the revenues and the quality of each business. Those become the basis for my weights. Based on my calculations, Vale is about 76% iron ore, 16.65% metals and mining, but 5% fertilizers and less than 2% logistics. The weights always have to add up to 100%. That's the only requirement. They absolutely cannot violate. The weighted average beta for Vale is 0.844. You know what the advantage of doing it this way is? I can use that weighted beta to value Vale as a company. So basically, I can come up with the cost of equity reflecting and using the debt to equity ratio. But let's say Vale wants me to value the logistics business. You're saying, why would they want me to do it? Because they're planning to sell it. They want a value for just the standalone business. I can value individual businesses. I can value add-ons. I can value subtractions. I can do mergers. I can value IPOs. Remember with the regression beta, how the heck are you going to get the beta for a company that is just going public? So you want to now, when you try this at work, you're going to get pushback. So let's see what the classic pushbacks be. Anybody want to try what the pushback would be?
This isn't consistent what we do. This isn't.
Well, that's not much of a pushback, right? Because lots of things that people do are stupid because that's what they've always done. And 30 years ago, you might have had no choice because getting these betas for 100 companies would have meant it would have been almost impossible to do. So that's the easiest of all. I'll tell you what a typical pushback. My company is so unique that there are no comparable companies. I mean, let's face it, a lot of the disruptive companies, when Uber came along and I valued it, of course, there were no ride-sharing companies. So we went for publicly traded ride-sharing companies. They said, this is a new company. It's not a new business though, right? Have we had car service for a long time? In fact, even before car service, you probably had horse carriage service, right? Basically, this is as old as, horses have been on the face of the earth. I don't know, maybe people carried each other before that. No business is ever a new business. They're basically new ways of delivering old businesses. So don't tell me Paytm is inventing a business or PayPal invented a business. Hey, MasterCard and Visa were there first. You've just done it in a different way. Through the smartphone, you don't have a card. So don't fall for that. This is a unique business. There are no unique businesses. You're just meeting an existing need in a different way. And maybe you have a different fixed cost structure. I'm willing to listen that if you're Airbnb, your beta is not the hotel beta, because that's a different challenge. Yeah.
What if you don't have enough competitors in the market?
How can you not? There are 46,000 publicly traded companies. How can you not find enough? You know why you not end up with not enough? Because you put artificial constraints. I'm going to look at only Indian companies. Who put that constraint? I've heard people say, you can't compare betas across countries. Really? Let me ask you a question. What's the average beta across all Indian companies if you estimated betas right? It's 1. What's the average beta across all African companies? 1. It's a relative risk measure. There's no reason. You can't compare P ratios across markets. I agree. But betas, it's like, if I took, 2 classrooms, one full of NBA players and the other full of, jockeys. And I computed the height of each people in each group. This would be a no contest, right? The NBA, the average height is going to be 6'6". So you can't compare. But what if I took the room of NBA players and I took each person's height and I divided by the average height of the person in the room, and the same thing for the room? Then I can say, you know what? In this room, this guy is in the top 20th, top 20% in terms of height. You can compare relative measures across different groups, even though they might have very different. I'm not saying a beta 1.2 in Africa is the same as a beta 1.2 in India. You know how I account for that? With an equity risk premium being much larger, the equity risk premium is where you bring in the risk component. This is just your relative risk measure. People constantly count beta risk multiple times. And here's how it shows up. You're valuing an Indian company. First thing the analyst will do is use the government bond rate. And they ask them, why don't you adjust for it? It's an Indian company. It's good to be conservative. Okay, no. Then they'll get to the equity risk premium. They'll put this gigantic equity risk premium. Why? It's an Indian company. It's okay. Then they'll get to the beta. And so, you know what? This is an Indian company. I'm going to use a higher beta. Come on. You beat the company 3 times across the knees with a steel bar. How the heck is this company going to come out on the other side looking good if you counted risk 3 times? Let betas carry. Remember I said, don't let the risk-free rate be a conduit for risk. It's risk-free rate. Don't let the beta be a conduit for country risk. It's got nothing to do with it. It's basically a measure of business risk. It's a relative measure of business risk. And the equity risk premium takes care of country risk. So in fact, I want to focus in on this, right? Because once you release yourself from that country constraint, you never run into this issue of, I can't find enough companies. So I had to value Embraer, Brazilian aerospace company. If I said the only companies I'm going to look at are other Brazilian aerospace companies, I am doomed. Do you know why? How many aerospace companies are there in Brazil? 1, and it's called Embraer. I'll be dancing around, one replacing one. So what about other Latin American aerospace companies? Guess how many there are? One, still Embraer. Unless you go global, you're not going to get a sample size. And in the case of Embraer, you have both economic reasons and statistical reasons for going global. What market is Embraer in? It's in the air. It sells aircraft to which airlines? United, to Singapore Air. I mean, in fact, it's competing in a global market. So with Embraer, I have absolutely no qualms about using global aerospace companies. With steel, absolutely no qualms about using global mining, global. You know, when I might hold back from global is if you have regulatory differences across regions that lead you to believe, or the way the product or service is designed in that region that lead you to believe that in one part of the world, products and services for this business are discretionary. In the other part of the world, they're non-discretionary. Telecom companies for the longest time at higher betas in emerging market companies than developed market companies. Why? In much of the developed world, telecom services become this necessity. You can't live without your phone. In fact, there are some parts of the world where you're required to give people phones, even if they can't afford it. It's part of the. But in parts of the world where people are poor, and as they get better off, they're buying phones, you can very quickly start to see this become a discretionary product or service. That's why I break betas down for emerging markets. So in some businesses, you might say, the global beta, it's too much of a reach. I'm going to use the emerging market beta. But you can almost never stay country focused because then you're going to be in real trouble in terms of finding enough companies. I'm sorry.
What about the size, for example, the company?
Give me a hypothesis. Do you think smaller companies are riskier than larger companies or safer than larger? You think they're riskier?
Yeah.
Why?
Have less opportunity, for example, there is a crisis or.
You think they have less power over pricing? There are small companies which have tremendous pricing power. Now, I'll give you the usual reason. Small companies are in localized markets. Larger companies can be diversified. You know that if I create a portfolio of 100 small companies and 100 large companies, you know what the standard deviation of the portfolios look like? Very much alike. Much of the risk we worry about with small companies, in fact, the entire basis for this premium, the fictional premium called the small cap premium, is the presumption that small companies are riskier than large companies. On an individual company level, you're absolutely right. But remember, as you start holding portfolios, much of the risk you worry about in a small company starts to get averaged out. That's why I don't add an extra premium. I'm not going to give a higher beta. In fact, I do compute betas based on market cap. See if small companies and big companies have different betas. Absolutely no difference. So I think that we'll come back and talk about the small cap premium. As I said, a fictional premium that every appraiser is trained to add to the numbers. It's just not there. It's not been there for 40 years. And people continue to use it. Why? Because once bad practices enter valuation, they never leave. The original rationale has been gone for 40 years. They still hold on to it. So if small companies were risky, you know how to chop. If I compute the betas for small companies versus large companies, you should expect to see small companies in each sector have higher betas than large companies. I've tried it. I get no difference. So finally, I gave up and said, why am I breaking companies down based on size? So can I use an unlevered beta from global companies for Embraer? Absolutely. For Vale, absolutely. But if you're a company where the regulations are different in developed versus emerging markets, you might want to consider using a smaller sample. And that's the advantage of starting with the biggest possible sample is you can say, you know what, I'm going to take out European companies because European banks are very different from the rest of the global banking system. So start with the biggest sample and then start to add things. That's the advantage of S&P Capital IQ is you put in the criteria, you get this really big sample, then you can start saying, you know what, I want to add this criterion because it doesn't capture the risk in a company. So if you feel size matters, that small companies in a particular sector are riskier because they have higher fixed costs, just add market cap as a constraint. If you have a big enough sector like fertilizer, 693 companies, I can just look at companies of roughly my size and get a beta for those. One final point about how these unlevered betas are computed. the debt ratio that I use in my calculations is the gross debt ratio. What does that mean? Nothing to do with what I think about debt. And so don't think of it as some sign of dirtiness of debt. Gross debt means I look at total debt in a company. In much of Europe and Latin America, perhaps even in Asia, people look at what are called net debt ratios. You know what net debt is? You take gross debt and you subtract out cash. The number is obviously going to be very different. In the case of Embraer, my gross debt to equity ratio is 19%. My net debt to equity ratio is minus 3.32%. That's the first thing to remember. When you do net debt ratios, you can end up with a negative number. Think of Apple, right? 100 billion in cash, 100 billion in debt, 200 billion in cash. It has a negative net debt ratio. I'm going to tell you up front, I have no problem with you using either gross or net debt. You're going to end up with the final cost of capital roughly the same, as long as you don't arbitrarily start cutting off numbers. You know what I mean by that? There are analysts, when they get a net debt ratio below zero, it freaks them out. So they use zero. So it can't be below zero. Yes, it can. And you got to leave it there because it's in a company. So if you decide to go the route of using net debt ratios, it's true your levered beta will be much lower. For Embraer, instead of getting the 1.08 that I've got the gross debt ratio, I'd end up with 0.93. This is going to push down my cost of equity, right? But I'm not done, because the cost of equity goes into a cost of capital calculation. And the cost of capital, what do? I take the cost of equity and multiply by the proportion of equity, the cost of debt and multiplied by the proportion of debt. When I use gross debt ratios, about 15% debt, 85% equity, I come up with the cost of capital. When I use net debt ratios, guess what those ratios are going to look like for Embraer? I'll have the cost of equity multiplied by a ratio that's actually more than 100%. Again, you chose this path, right? Net debt ratios, you got to go down it. You can say, my equity is 102%. My net debt is minus 2%. That's why your cost of capital doesn't change much, because in my first approach, the gross debt ratio approach, having debt lowers your cost of capital, that 15% at a lower cost. But when I use net debt ratios, I'm actually going to end up with roughly the same cost of capital, because now I don't get the benefit of debt lowering the cost of capital, because I'm using a net debt ratio that's actually negative. So I tell people, look, you pick net debt ratios, that's fine. Just stay with net debt ratios when you do this. Do this when you do bottom-up betas as well, right? Don't. So I think you got to make the choice early in the process, because you go back and forth, bad things can happen. So let's summarize everything we've talked about in the last couple of sessions. Your risk-free rate has to come from the currency you pick. Your beta should reflect the business or businesses you're in. And if you want to adjust for leverage and operating and financial leverage should be there. And your equity risk premium reflects where you do business. Every number in this calculation carries its own weight. Risk-free rate carries the currency weight, the beta carries your business weight, and your equity risk premium reflects where you do business. Don't let them carry multiple weights, because then you risk double counting, triple counting risk. And I'm completely agnostic about how you measure relative risk or what currency you do the valuation in, and even how you come up with equity risk premiums by country. But try to keep them isolated in the numbers that are supposed to carry. I will see you next Wednesday online. So reminder again, it's a Zoom session. So I will see you next Wednesday online. But we'll talk about cost of debt and capital. Hey, Carl. Yeah, you do it. Prevent double counting, because if I didn't do that, I'll end up double counting it, right? I'll count it once as part of my risk premium, right? And then I'll count it again as part of my risk premium. I'm doing this purely for the purpose of making sure I don't double count. So whether you're in India or not is irrelevant. Right? Because we leave the government bond rate as your risk-free rate, and you also demand a higher risk premium because India is risky, and you put the default spread and you measure that risk premium. It's showing up two places in the same calculation, right? As a higher base from which you're making it off, and a higher risk premium. So this is purely a mechanical thing, because ultimately it gets added back. right? I'm just saying you get 9% on bond. It's not because it's risk-free. 7% was because it's risk-free. 2% was because of country risk. That country risk belongs better in the equity risk premium part, not in the risk-free risk. Exactly. Exactly. And the advantage of doing that is we have a company like Infosys, which actually is an Indian company, but has all of its revenues outside India. You're not unfairly punishing it. The problem with leaving it in the risk-free rate and saying, hey, it's going to be there anyway, why am I netting it out and then adding it back? Is because there'll be companies like, not the beta, the equity risk premium for Infosys will be the US equity risk premium, because that's where it gets a bulk of its revenues. This allows you to kind of isolate country risk and differentiate across companies, whereas just putting it into the government bond rate means every company now gets that same constant added on to its cost of equity. Tata Motors, TCS, both get punished the same way. That's not a lot of people have. As I said, the way people compute discount rates is full of contradictions that reflect history. I mean, remember the way all these numbers came from the US. So the way you do them is in the US, you were taught to use the government bond rate, right? The T bond rate was assumed to be default free. So those books were carried to India, to Poland, and now everybody there takes that equation and say government bond rate, they put in the, what they're missing is you're in a different market now. The government bond is no longer default free. It's not that the equation is wrong, but now you're applying it in a market where it doesn't apply. Okay. Hi.
I have a question. I'm not sure if I'm thinking about this.